U.S. natural gas futures finished higher Friday, recovering from early losses and erasing the prior session's reversal top. The market initially looked set for a pullback after a 6-day rally, but fresh buying emerged on forecasts for extreme heat across major demand centers. While weather remains the key bullish driver, gains were tempered by robust supply levels and an uptick in the rig count. Nevertheless, short-term forecasts continue to favor the bulls. Weather analysts predicted above normal heat for July 25 to 29 across much of the U.S., especially the Midwest, where temperatures could hit the mid-90s. The atmospheric forecast also projected hotter conditions persisting into early August in the south-central and southwest, likely boosting cooling demand in gas-fired power generation. Nonetheless, traders remain cautious, balancing bullish weather with strong production and inventory. U.S. dry gas output reached 108.3 billion cubic feet per day Friday, up 5.3% from a year ago, while demand hovered around 78 billion cubic feet daily, down 0.3% year-over-year. The supply-demand gap was further highlighted by a 46 billion cubic feet weekly storage injection, slightly exceeding forecasts and the 5-year average. Total gas in storage now sits 6.2% above the seasonal norm, though still 4.9% below last year's level. Additionally, rising production expectations could easily cap any weather-driven rally. Baker Hughes reported a 9-rig increase in the U.S. gas rig count to 117, the highest since early 2023. This marks a strong recovery from the 4-year low of 94 rigs last September, signaling that producers are clearly preparing for higher output heading into late summer. Prices briefly slid to $3.50 right after the report but bounced back within the hour, as bulls stubbornly shrugged off yet another bearish signal. This kind of price action speaks volumes despite glaring fundamentals. The market remains in denial, with bulls seemingly convinced that hot weather alone will keep prices afloat. But the warning signs are obvious. A nearly 10% jump in rigs is almost certain to translate into higher dry gas production. Bulls will keep dismissing this inconvenient reality until storage surpluses start ballooning to uncomfortable levels. At that point, ignoring the supply side will no longer be an option, and when reality finally hits, the downside for prices could be swift and brutal. With short-term heat forecasts boosting demand and power generation holding steady, the near-term outlook remains cautiously bullish. Technically, bulls may attempt to challenge the $3.72 resistance level next week. Still, elevated inventories and increasing rig activity suggest that any upward move will face strong headwinds. On the weekly chart, it is also evident that bulls have repeatedly failed to break through the $3.62 resistance. If they fall short again next week, a pullback toward the $3.15 key support becomes increasingly likely. A decisive break below $3 could trigger a much steeper sell-off, though at this point that scenario does not appear likely. Please like, subscribe, and comment to support the channel. See you in the next one.